These gap downs are a reminder why the opening and closing prices of the gap down and gap fill candles are generally more important, but it is still beneficial to mark a broader gap down range and gap fill range, as shown by the 1167.20 and 1075 levels that encompass swing points shortly before and after the gap formations. The double bottom in August has all the ideal features and completes successfully, but is a rare case where a bullish reversal is not established further. The 1040 level is currently producing another major drop, as the market has been unable to fill in the gap from a year ago, and the short to medium term context sees the bearish pairing of a strong gap downfill and a declined double top. There is also the aspect of a descending triangle due to the minor upswing and downswing between July 16th and July 23rd. Even if the gap down range from August 2014 was widened down to 920, the solid downtrend in August 2015 only saw it offer temporary support. After crossing the downtrend lines from the main bearish reversal patterns, there is the normal neutral to bullish price action developing. 920 now becomes an immediate obstacle to further uptrend development. As 920 is cleared into April, the other previous levels mark areas of temporary resistance to a solid uptrend, stemming from the general flat bottom from late 2015 to early 2016. It had a widened upper boundary due to the past significance of 920. As the chart peaks again, the bearish reversal is more of a regular downtrend, rather than a declined double top. In any case, the trend lines from the first two downswings are helpful guides, along with the previous levels now returning to offering support potential. A flat bottom does complete but has a lowered impact due to the bulk of bullish sentiment being exhausted in crossing over the downtrend lines to begin 2017. Then in the long term, the market is neutral to bullish, after the old downtrend begins to lose significant influence towards 2018. This leads to a more sustainable double bottom, transitioning to a less strict triple bottom from May to September 2017 to form a more significant recovery off the still solid 920 level. Although the current downtrend originated from the March downswings at 1075, most bearish activity forming the stable decline has centered around the old 1040 gap level, which is theoretically more significant. A larger descending triangle outline finished quite early. It had a wider base due to volatile upswings and the strong supporting influence of the 990 level that had been the upper boundary of a recent range. From April to May, there was what appeared to be a double top, but this was merely a pair of downswings within the developing downtrend and descending triangle, because it was not at the top of the uptrend. Pairs of downswings or upswings in a range-bound context, after a trend begins developing, can't be classified as double top or double bottom ranges. Even if the solid 920 level is surpassed, there will be important resistance to take into account from the descending triangle's downtrend lines. Shorter-term bullish sentiment presented price action from a possible ascending triangle in early 2019, as an incline held around the firm 920 level. Additional bearish sentiment only emerged when trading neared the downtrend lines for greater long-term resistance potential closer to the 940 level. The descending triangle's trend lines continue to have a pronounced impact on the chart, in the form of the descending support, during another downtrend falling from 920. In the short term, September to October has seen 3 methods rising price action developing a solid range over 920 that now becomes a key short-term boundary of support. Although there is progress over 920, a flat top and, later, an inclined double top develop with 940 as the focal point of their resistance boundaries, while their lower boundaries are extended to 920, since this level still retained long-term influence. This can be seen by the temporary pause each bearish reversal made at 920. When there is finally a long-term recovery going well past the gap fill levels from 2014, the bearish to neutral price action under 940 to 920 is outlined as a clear flat bottom on a large scale. When the firm upper boundary defined mainly from 940 to 920 is surpassed, it was preceded by a stable uptrend and swift bullish break, similar to smaller scale flat bottoms, double bottoms, and triple bottoms. The aggressive uptrend is stabilized with regular bearish retracements and minor ranges between bullish continuations forming, mostly within the old ranges above 990. A look back at the large flat bottom range reveals smaller patterns, with a double bottom first defining the solid lows around 813. Then the already important 920 level becomes the site of a failed ascending triangle that had a slope similar to the broken uptrend line from the double bottom. Interestingly, there is a more gradual drop following the failed ascending triangle, since a stable downward channel forms. This is in contrast to failed ascending triangles, often incorporating double or triple top drops, for a near vertical drop to break under the failed ascending triangle's outline. The area around 18 is also further validated as strong support with a very clear morning star price action. Interestingly, the descending triangle's downtrend lines mark the bottom of general head and shoulders price action that failed to produce an accelerated drop. Though this formation is not strictly a head and shoulders due to the wide fluctuations and severely distorted proportions. The bullish reversal completing September 2019 is a less strict triple bottom range that is more difficult to spot due again to rapid short-term volatility. Then those two bearish reversal ranges covered earlier form a large-scale double top range in a more neutral to bullish context, transitioning into 2020. Instead of single downswing points, they define two reversal areas.